to spend it with you. And you got just me today, but we're not going to do that on a constant basis. I'm going to ask Kenneth to come back in. But I have to talk to you about something very, very significant and serious today because, yep, I had a chance over the weekend to take a look at consumer sentiment, and it has fallen to all-time lows. This is the lowest level it's ever been since they started tracking back in 1952. This is not a good thing. But there are a lot of things that lead into it because this is a con game. It requires confidence. And when that confidence really starts to crumble, you got a big problem. The governments, the central banks have a big problem. Gas prices have gone up fast. They will take longer to fall. So these high gas prices, how do you think that might possibly impact consumer sentiment? Not in a good way at all. And yeah, they go up fast, but then the stations are trying to balance out that rapid rise so that you don't get choked. So they have to stay up longer. So they try and recoup the money that they're losing during that period of time. It doesn't really matter. The point is that there are higher prices at the pump, and rapid and high inflation, noticeable price spikes in anything is a problem for confidence. Here, I love this one. Ways to cope with rising property taxes. The average bill rose 3% last year. Appeals, exemptions, or deductions could help. But actually, you know what helps even more? Having gold to enable you to always pay your property taxes. I recently did a video on that. If you haven't seen it, go back and take a look at it. It's part of the strategy because what we're really looking at are patterns that repeat every single time. And I don't know, do you think this time could be different? You know, that's what they always say, but it never is any different. And I don't think this time is going to be different either. So are you really ready for this? I'm going to get into more, but the one last headline that I want to talk about or bring up anyway, because the U.S. begins the first steps to refund $166 billion taken for illegal tariffs. These payments are for importers, not consumers. So all of the tariff inflation that you paid, you're not getting any of that back. And I'm not so sure that you're seeing prices decline either. That all goes into sentiment. And consumer sentiment is something that our government and our central banks, it's not coming up for whatever reason. Oh, there we go. Oh, it went way too far. Sorry about that. Okay. But, you know, consumer sentiment is not something that we can afford. So here are the 6 stages in the life cycle of money. It's interesting because I actually didn't check the animation on this beforehand because I had just done it. So at any rate, you can see that the foundation is the gold and the silver. Then free money markets emerge. Oh, wow. Okay. Sorry about this. I'll fix this and you'll have a new one next week. I should have looked at it. It's my fault entirely. But then they introduce fiat money. That's free market money. That's what they're calling it here. Government then regulates it, which means that gold and silver are pushed to the back. They're not eliminated from the system, but they are eliminated from your ability to use them and maintain your purchasing power as this crap grows in more dominance. So much so that the government then monopolizes the money, which enables them to debase the currency, rob you of your purchasing power until this is where we're at. No confidence in the money and in the system. And then what happens is this system collapses into hyperinflation. So I'm telling you, this is probably the single most important thing that we've been talking about for a while. And we've been talking about that loss of consumer confidence and consumer sentiment. This is from Trading Economics. And it actually shows you where it has fallen to. 47.6. Look at the low that hit. That broke every single level of support. This is what I've been watching for, waiting for. And now you are warned. So I don't know. I'm telling you, you do whatever you're comfortable doing. But I'll just put it this way. I am very glad that I have my strategy in place and executed, along with surety in food, water, energy, security, barterability, which for me is primarily silver, wealth preservation, which for me is primarily gold, community, which is arguably the single most important thing that I ever talk about, because we have to come together in local community to create surety in all of these areas. And we have to create a global community to get redeemable gold, sound money back in the global monetary system again. We have to do this for the future generations. And now, because consumer sentiment has fallen so far and broken that last level of support, I'm telling you right now, you can believe me or not, but the clock is ticking. And that's what I've been saying to you all along. When this happens, we are running out of time rapidly, because it's a con game and it requires confidence. And this was broad-based against every single consumer area of the economy. This is not good. And what happens to the markets? Well, we're in melt-up mode. We've talked about this before. So even though consumer sentiment fell to the lowest level ever since tracking began in 1952, stock markets don't care. Look at the earnings. Look at this. Look at that. It's all lies. How many times can you be lied to when you do not know the truth? Every single time. Now, this is the single most important thing that I'm talking to you about. But next week, I'm going to be showing you how they use these markets, these spot markets, to keep that lie going. But make no mistake about it, this isn't about what's happening in the economy, and it's certainly not what's happening to the consumer. This is all about a trading market. Once we shift it into a pure debt-based system, it's all based upon cash flows and how much the government can print and push out there into these intangible assets. And it's hard for me to even call them assets, because the reality is that you can only convert this stuff into dollars, into this stuff that has seriously, absolutely zero value on its constant march to zero. So if you haven't gotten prepared and created surety in food, water, energy, security, barterability, wealth preservation, community, and shelter, get it done. What are you waiting for? Because you can mark my words on this. I'm putting my neck on the line and I'm standing behind this. This consumer sentiment piece is not good. It tells you how close we are to the end. Because first it was bank-to-bank trust, then it was central bank to central bank trust, then it was markets to central bank trust. Now it's the public, and that's the biggest factor of all. Are you ready for it? Because you need to be ready for it. Because at the same time, what are people anticipating? Higher inflation. Inflation expectations are reaccelerating. They are trying to get them anchored, what they call anchored, which means that they believe the credibility of the Federal Reserve. They believe that the Federal Reserve is trying to get that 2% target, which is garbage anyway. And it was really interesting. I was listening to the confirmation, or the hearing, wasn't a confirmation, the hearing with the proposed Fed chair, Warsh, and he said, well, he has a different definition of price stability. I said, oh, he does. Okay, let me hear what it is. It is prices that move up. It's actually not a different definition, but it's prices that move up that nobody talks about, meaning that it moves up slowly enough that you don't change your behavior, which is exactly the central bank definition of price stability. He has the same definition. How about price stability definition being the price of that milk does not change? It has a stable price. Because even if it just goes up 2% a year, it's still going up, isn't it? That's not a stable price. But if you don't change your behavior, but rather you take on more debt to do it, they get what they want. They get your purchasing power. You have to work harder and harder and harder. And this whole affordability issue, when you look at the debt levels and the fact that most Americans cannot come up with $400 in the case of an emergency, we haven't been affordable in a very long time. And when you compare incomes to gold from 1913 to 2026, we are getting paid less than we were at $68,000 for an average wage, than we were at $800 for an annual average wage back in 1913. Corporations got what they want. They got to pay you less and less and less for your labor. What else do you have to barter with? You need to learn some more skill sets. I'm telling you right now, take a look at what's happening with the money. This is the money printing. And this is the M2, which means it is not the broadest base of money, but it just broke, right? Took a little dipperooski there. Oh, no, 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 no. We can't have that happen. We need all of this money just sloshing around in the system, sloshing from this asset, this trade, to this trade. That's really what it is. It's a trading economy. Banks are making a fortune off of this trade. They used to make money off of lending. Yeah, they don't make so much money off of that. They make it off of trading. It's all speculation. How do you feel about it? And we really don't even know that level of speculation. But I wanted to show you this because I talk about the velocity of money. That is the speed at which money changes hands. And this, you might recall, was I showed a long-term chart. And if you want me to do one just on monetary velocity, a little thing, I can do that. And that's probably not a bad idea anyway, to do it. But monetary velocity, is the speed at which money changes hands. So, for example, in a stimulated economy, if I have a good week, I might say, well, I've had a pretty good week, so I can take my sweetheart on that vacation that we've been talking about. And now you book the vacation, so the money transfers from you to the agent, travel agent, hotel, restaurant, and all of that. And maybe you're feeling pretty flush when you go to a restaurant, and so you leave an exorbitant or a nice big tip. And that wait person goes, now I can get Johnny those sneakers he's been needing. So the money transfers from you to that wait person to now the storekeeper that has the sneakers that Johnny's been needing. So it's the speed at which money changes hands. When you think that prices are going up rapidly, you can pull forward, or you do pull forward your spending. So you see that big spike in consumer, in the velocity of the money, and then it's slowed down the speed to a degree, but it continues to go up. So what I just showed you, these are the two things we've got to be paying a lot of attention to. The sentiment, inflation expectations, and how rapidly people start to spend whatever money comes into their hands. This is exactly what happens during hyperinflation when they realize that the currency is being devalued so rapidly. Well, they go and they spend it on anything that they think can hold its value better. So really, when confidence dies, so does that fiat money. Absolutely, 100%. You can see it. You can see that pattern shift. I'm going to be watching for a big spike in it because, quite honestly, back in 2013, it was lower than it was during the Depression, according to the Federal Reserve. That's not my opinion. That's according to the Federal Reserve. This is not good. Everything that I'm showing you, I wish I could show you something else. And by the way, we've been talking about this quite a bit over this period of time with that runoff. This is the Federal Reserve balance sheet. And you can see since 2008, but whoop, right up. Well, all of this money printing that they did in 2008 had a whole lot more impact than it did. That big spike up, that was 2020. And they've been trying to just let things run off. In other words, when a bond matures, then they just don't reinvest it, right? So they haven't been selling treasuries. They've just been allowing their balance sheet to mature and run off, although they have a lot of longer term stuff. However, I told you when they made the announcement that the balance sheet runoff is over, and this is what it's looked like since they made that announcement in December. I'm telling you right now, you guys, are you ready for this? Because it's over. Now, let's take a look at the spot contracts. I really, really, really want you to get that this is fiction. This is trading, easy peasy to manipulate. Doesn't reflect the true value of this. But this is the spot gold contract. And you can see where it topped out, right? And you can see where it is right now. And that line is showing you that it was trying to break out, right? Break above, like the spring, right? Whenever you put pressure and you artificially push down on something, when you remove, and I didn't do that very well, but when you remove your hand, it springs and shoots in a direction. Do they want spot gold contract to go up? No, because then you might be wanting to buy gold. People always want to buy on the way up. I'm telling you that without any doubt in my mind, we will have significantly higher gold. But in real terms, I don't personally care what happens to the contract, because they could create as much gold that does not, and silver as well. And we're going to do the silver contract as well. But they can create as much of that as they want to without limitation, and so dirt cheap. They can control many millions and trillions of ounces of gold to reflect the trading market. Easy enough to suppress. But the 200-day moving average, I pulled this data from Friday. The 200-day moving average, 41.9143. So on Friday, where it closed at 48.33, it's a bit below that now, but it was still, what does that say? 15.33% above that 200-day moving average. Do you remember me telling you that 10% above the 200-day moving average is a lot? And that 200-day moving average kind of works like a rudder on a boat. And so if the spot price is a water skier, there's only so far below or above that it's going to go before coming back to that center. So none of this even technically does not put it in a bearish market, but it is a contract. And it does not reflect the true fundamental value. And you need to understand the true fundamental value of anything that you're buying. If you're sitting in the stock market or you're sitting with cryptocurrencies, and by the way, this is the physical representation of a Bitcoin, which does not have a physical body. But, I know now why they put it in these cheap cases, and I probably didn't even pay more than $5 for this thing. It's because without it, boy, that gold color just wears right off because it's a fake. They want you to think that it's like a real gold. It's not. It's not. It's not. It's quite simple. It's not. But if that's where you're holding your wealth in these intangible assets and you can only convert them into dollars, you got a problem, because the real trend is not whether or not they make the stock markets melt up. We're in melt up mode. There's no doubt about that. And that's what always happens before a crash and a crisis. I don't care about, well, I do care because I want you to be prepared and I want you to be ready for it. But the reality is this is a trading market and this is your opportunity to, it really only impacts the raw stuff. And then there are still premiums in there because of the true supply and demand dynamics. That is taking hold. Make no mistake, the paper markets will fight it, but doesn't really matter. At the end of the day, it's what's going to happen. Period. End of discussion. Been in these markets on some level pretty much my entire life. No doubt about it. I understand the truth of it. This is your spot silver market. And you can see these big red line down, whether you're looking at spot gold or you're looking at spot silver. Did these markets really change that fast? No, they didn't. I'll be talking about that in more depth next week for sure. But what we see here with spot silver is, guess what? It's already broken out. And that means that I would anticipate higher spot silver, no matter what happens on a day-to-day basis. But again, where is that 200-day moving average? My goodness, it's at $60.26. So with the spot as of Friday, I have to look over here, it's still 34% above the 200-day moving average. If 10% is a lot, then can you see that those spot contracts remain in overbought territory? They don't mean anything. Nothing. Look at what's happening around the world. They want to keep you away from the physical metals because this is truly decentralized. This is truly the only financial assets that when you hold them in your hand and they're in your name, you own it outright. Period. End of discussion. Nothing else. No other financial assets can say that. And that's according to the Bank for International Settlements, not me. So those are the technicals. I'll take some questions, type in more questions, and let's just rock and roll hoochie coo. As I think that was the last slide. Okay. So John Roseman 9087 asks, Lynette, I have a question for you, and I hope it's not a stupid one. There are no stupid questions. You can ask me anything at all. Because if you have that question, at least 100 people watching also had that same question. Gold and silver works off of the spot. The spot is determined by the traders. And you spelled it the right way, by the way. I like that. Before we had those traders, I'm assuming the spot didn't move much like it does nowadays. When the chime comes for us to use our physical silver and gold, will the spot remain stable? What I'm trying to say is if you buy a car with gold at a certain spot and the spot decreases or increases, what happens to the deal you just made with the car dealer? So there are a few things in here, and let's just kind of break it down. And I think some of this I could make more clear. So if you would do me a favor, Tom, and make sure that I get that whole question, because this is what I'm going to be talking about next week. And I'll show you when they invented the spot market, saying that they were going to build, just like they're doing with the cryptocurrencies, they're going to build a very large intangible market to keep it away from the physical markets, which benefit you. Okay, so let's break this down. At the moment, raw, meaning like this and like this, do indeed reflect the spot market, though dependent upon supply and demand, like in China, by the way. They pay a premium to the spot market because there is greater demand for the physical. And we've had backwardation and things are shifting. So they do at the moment work off of spot, but there's also a combo where it's demand driven. We're seeing that more in Asia at the moment. That's not always been true here, and it's not always going to be true here. We see that more in Asia at the moment, but yep, it works off spot. The spot is determined by the traders. Yep, at the moment, yep, that's true. Before we had those traders, I'm assuming the spot didn't move much. It didn't because it was a fixed price. Both gold and silver were fixed starting in 1913. It was at $20.67 an ounce. Hence, that's why you've got this 1 ounce coin. And then silver was fixed at $1 an ounce. But as they printed more money, right, to lift off this game, which is the way they always do it, then they were more dependent. They created the spot market when we went into the 70s. I'll show you this next week. And they actually said to diminish demand for the physical, which we hadn't been able to hold more than 5 ounces since 1933. So it didn't move much because it was a stated value regardless of how much of the printing presses were going. That's how they lifted off the lie. When the time comes for us to use our physical silver and gold, will the spot remain stable? It's going to be when the time comes for us to use the physical metals, it is more than likely, because the strategy really can address short-term emergencies as well as intermediate-term protections and debt repayments, and then longer-term wealth expansion and income creation. So there are a number of parts to the strategy, and the spot will remain much more stable than it is right now, because by the time we're in that second part of it, it will be moving toward its fundamental value. So I'm not going to say that they're going to fix the price again, nor do I want them, but we will be in a pure supply, more than likely. I can't guarantee this, but more than likely we'll be in a pure supply and demand market, because like we saw on this first slide, let me go all the way back to it. The way this is set up, I can't just, we didn't really need to show all of that, but that's okay. There. Oh, okay. So, this is interesting. Let's see what it does. Oh, I just screwed up the animations before. It was on me. Okay, so let's go back to the 6 stages, because we're going to be starting at the top again, that barter market, where that begins. So the government regulates the markets. First, they took the ability for the public to convert their dollars into gold. They did that in 33. Then they did the same thing by removing the silver from the system, which then gave the government pure monopoly over money. But you'll notice on that even though gold and silver are faded in there, they're not gone. They're still totally part of the global monetary system. This is where we are right now, that no confidence in the money and the system collapses. That's what I'm trying to show you for today, is that loss of confidence is a trigger for the rush back to gold and silver and the barter market to begin again. So this is where we are. I don't know why it didn't work the first time I tried to make it work. But, we're alive. It happens. So everything always goes full circle. This matters so much more than I can say. No confidence in the money system collapses. But what are we working for? We're working for corporate debt. And people are starting to learn that now. And that's why they can inflate it away, because it really has no value. So You're assuming the spot didn't move much like it does nowadays. So when the time comes to use our physical gold and silver, will the spot remain stable? More stable, but what's really going to happen is that things will be valued and priced in terms of gold and silver like they are doing. And I did a video on this, but like they're doing in places like Venezuela and many other places that are currently experiencing hyperinflation. So remember, up until really the 40s, everything was valued in terms of gold and silver. It wasn't valued in terms of dollars. That was a slow and steady getting you used to it because they had, remember, here we go. They started with this, gold. Then they brought in these gold certificates, but don't worry, because they put a little gold over here. So, hey, this is the same thing. You can walk into any bank with this and walk out with this. So isn't this a great thing? They're just the same. But then what did they do? They ran that right alongside it. And actually, that's a newer one. Where's my little bit older one that looks, here it is. Okay, this is the one. Pre-1971. Now, you tell me, how much does this Federal Reserve note, corporate debt, look like this gold certificate? Not a whole lot of difference, is there? Nope. And they all ran together for 20 years. So when they took this away, everybody thought that nothing had changed because, after all, we still had this. But what they never bothered to do, and if you haven't done this yet, I'm going to encourage you to do it. You look at the top and what it says across here. Federal Reserve Note. The Federal Reserve is not a government agency. It is a private corporation. For profit, mind you. A private corporation. And a note is a debt instrument. And nobody, I mean, if you do a little bit of reading, nobody's hiding the fact that this is debt, but it's corporate debt. And so confidence in the corporate debt and in the government's ability to create more debt, that's what supports this whole system. And if we've lost that, what do we have? So if you buy a car with gold at a certain spot and the spot decreases or increases, what happens to the deal you just made with the car dealer? Well, first of all, if you made the deal with the car dealer, that's firmed. But let's talk about the gold clause. It's called a gold clause. Because if you're executing our strategy and you end up becoming a landlord, we will recommend that you have a gold clause, which is legal again and used to be in all of the contracts prior to 1933 and up until 1933. And what that was is you could pay this much in dollars or this many ounces of gold. And when you set the contract, those are both equal. And whoever sets that contract is the one that has the right to execute it. And it really is about making sure that you're always fairly paid. And a great example of this, actually, it happened in Los Angeles. And there was this old building that this major insurance company had taken out like a 100-year lease or something like that on it. And it had a gold clause in there. But in 33, when they took the gold out of the system, they negated and made illegal all of those gold clauses. So the gold clause was still in that contract, but it didn't matter, right? Then they went about devaluing the currency. You've seen the purchasing power charts a gazillion times. And when they made it legal for the public to hold gold again, they also re-legalized the gold clause. Well, this company had been paying what they had agreed to pay in the early 1900s, and here we were in the 1980s. And I can pull this case. I have it somewhere, but I can pull this case up if you want to see it. And so the owners of the contract went in and said, no, we want to execute the gold clause that's in that contract. And so how much do you think that changed? Because back when that clause was put in, it was $20.67 an ounce, right? Now in the 80s, it was about 200 and, 400, 200 bucks. I mean, I'd have to look at a chart to see. So the gold clauses are something, it didn't quite answer your question, but it opened up the opportunity to talk about a gold clause, which I think is very important for all of our listeners to really understand. Because if you're working with us and you're executing the strategy, that means that at some point in here, you're going to be converting a chunk of your gold anyway into income producing assets. And that means you are going to need a contract. And that also means that what we will highly recommend, as long as it's legal, that you would put that gold clause in there, because when we go into a brand new system, another thing that happens 100% of the time, because they're trying to get your confidence back. What gets your confidence? Gold. Gold gets your confidence, right? So gold will be part of the system again. If I have my way, it'll be 40% and it'll be redeemable. I don't like what you're doing, government or central bank. Give me my 40% gold. Why? Because gold creates restrictions around what governments can do, how much debt they can grow. We, the public, must take our power back. If we fail to do this at this opportunity, and I've never seen another opportunity like this to do this, if we miss this opportunity, I don't think I'm 100% certain we won't see it in my lifetime, and probably not for another 100 or 150 years. And going back to what the central banks define as price stability, well, debasing this, here's the problem for them. This is a debt instrument that they say, not me, they say, does not charge or pay interest. It's not flexible enough because there's only so many points that you can go past zero. So if it's $1, it's $1.00. All right, maybe they can go out a couple more points. Once we're on a purely digital system, are there any limitations to how far out those digits can go? Or their ability to still inflate away the value of the currency, but do it even more invisibly than they do it right now? If we don't stop this lie, because you know the truth, then we're complicit in it. And that's not what I want to do when I'm standing in front of my grandchildren saying, yeah, well, I knew about it, but more, you look in the mirror and you go, if not me, who? And if not now, when? It's you and me and all of us out there, and the time is now. So I don't know if I exactly answered your question because there was a lot to it, but let's see if I can do better next week. Because I think it's an important question. It had lots of nuances in there. And Patty Irishman 9059 asks, my friend has 5,450 ounces of silver. What can I tell him to do? He bought the silver in 2012. Sit on it. That's what you can tell him to do. And, you could also have him call us so we can set up a strategy. Really, you can do everything with silver that I'm talking about doing with gold. The difference between the two is the efficiency, right? And we have it broken down to what's better for silver, like gas in your car or a pint of strawberries or something like that, very local, versus property taxes like we were talking about. But you really can do the whole strategy with silver. The problem is that it takes an awful lot of silver to do the same things. And I can guarantee you that I have absolutely hammered in nails to hang a picture with the back of my shoe. It works. I've done it. But a hammer makes it a lot more easy. It's a lot more efficient. So it's always the right tool for the job. But I'm just frankly thrilled that he has the silver. So what you should tell him to do is to give us a call and let us do an analysis and make sure that what he has is it's not just the right thing, but it